Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Glad to be back in the studio here today as we strategically planned this podcast today on Friday, July, whatever it is.
28th.
After the Fed announcement, after some key earnings come out. So we got a lot of cool things to talk about today. I'm going to hit you guys with 3 reasons why this bull case should still be expected on the back half of the year. But glad to be back in the studio, man. Like, how's everything going for you? Trip over from Louisville was good, obviously.
It was great, sunny. And for those of you that aren't in our region of the United States, this wonderful country, the Ohio Valley is particularly spectacular. It's lush, wonderful, it's beautiful. This time of year.
Hot as hell, though.
It is a scorcher. We're going to see actual temps over 100. Heat indices are already well into the 1/0s when I was on my way up here. So needless to say, I didn't have my window down.
No doubt.
But, and I'm happy to be here post JP's JP, which is Jerome Powell's Jungle of Pain.
That's right. That's right. Not so much pain looking forward here. That's what markets are expecting. We got an awesome rally today. This is kind of what I was hoping for. So I'm going to get into all that stuff today, but just to wrap up the intro part of this, not only is it going to be hot all weekend, my family's going to be at the pool, but I got talked into doing a Tough Mudder tomorrow. Never done one before.
I was going to say, no rest for you this weekend.
Not at all. We got to get up and drive about an hour and a half somewhere in Indiana is where this thing is going down, like 10 o'clock in the morning, something like that. It's only a 10K, so I'm not worried about the distance. Like it's kind of a normal jog for me is about 6 miles.
Yeah.
But obviously this is going to be going up and down hills and obstacles, all this stuff. I've never done anything like this before. So I'll let you all know how that experience goes.
Yeah, please do. Because on paper, it sounds awesome. It's like, hey, this weird jungle gym for adults. You're like, tight.
Yeah, exactly.
Also some Hunger Games mixed in there, maybe.
So a neighbor friend of mine was just like, hey man, this is going down. You want to do it with me? And I'm like, yeah, why not? Never done it before. Yeah. I'm into, physical activity. I would just prefer not to have to do it tomorrow, given the week that I've had, which has been a great week. I have nothing to complain about, but it's been early days, late nights, a lot of meetings, quarterly reviews, driving all over the place, and would love to catch up on some sleep. But you know what they say, you catch up on sleep when you're dead, or maybe I'll just do it on Sunday. How about that?
I don't want to say, I'm sure the night after that Tough Mudder, you're going to sleep like a baby.
I'm looking forward to it. All right, so let's start off with the 3 reasons for the bull case. So we're going to go over these in detail. I've talked about a lot of this stuff all year long anyway.
Okay.
So the first major wall of worry, I think we've now finally seen that wall of worry just crumble before our eyes. I've been calling for it for a long time. The first reason for the bull case, inflation's falling faster than consensus expects. We just got a CPI number a few days ago. CPI came in at 3% annualized. We peaked out last June at 9.1%. The Fed's striving for a 2% CPI. We're at 3%. I'll spend more time talking about that here in a little bit. Earnings, everybody said earnings was going to be awful. This is like the apocalypse of earnings here in Q2. Awesome earnings.
Yeah.
Earnings expectations are rising. Number 3, I've talked about this since October last year. CapEx spend. What does that mean? That means companies, CEOs, CFOs are spending money. What are they spending on? Things that will solve a problem for them. Their problem is they don't have enough people to do a task. That CapEx spend on AI is real, and AI is actually solving that problem as we speak today.
Yeah.
So welcome to the program. We'll spend some time diving into all of that stuff. Anything else you want to make sure we talk about is?
No, it's a slow day or a slow time of the year for all of our hobbies. I mean, obviously we're in the middle of MLB season, which I know is big for you, but basketball's not much going on. I have been enjoying watching the World Cup this year. The women's teams doing well so far.
Equal pay.
Yeah. I mean, they're also just awesome.
Well, they're way better than the men's team.
Straight up dominating.
Yeah.
I mean, they're literally a global dynasty.
I'm good with that.
But nothing else really going on.
So here's the deal, though. I got a bone to pick with some people around our generation.
All right.
So year to date, the S&P 500 is up damn near 20%, like 19.9%.
I like that.
NASDAQ's up way over 30%. I can go on and on. But I ran across an article kind of preparing for today. And I just have a bone to pick real quick. I'm going to start with this and we'll get into the other stuff. So there's an article here is written by money.com. And the headline says investors are building up their cash reserves, millennials especially. All right. So I'm not technically a millennial.
Not this millennial. Or are you Gen Z?
I think so. I got to iron that out. I think I'm right on the line there. Something like that.
Yeah.
But essentially, these guys and gals around our age have more cash than really they've ever had. They've been building this since March of last year.
That is a straight up lie because I don't know any millennial with money.
83% of millennials are holding on to their cash reserves, which means they missed out on all this market rally.
Okay, I understand what you're saying now. Yeah, I would say that is a big thing, that there's a fear of participation for a lot of millennials, especially those that had the unfortunate buttressing of some of their prime earning years with 2008 and then the pandemic.
Well, my gripe with them is their greatest asset is their longevity, the time horizon of their life expectancy. And if they ever want to retire at some point, they say the best time to plant a tree was yesterday and the other best time is today. You can't time the market. I have no idea over a short span of time what the market's going to do in any one, day or week or month. But over a long period of time, the market is extremely predictable. And one thing that you cannot do with your money is buy back time.
That's true.
So these folks that are sitting on all this cash, they might be thinking to themselves, I missed out on this 20% rally. I'm here to tell you that there's more to come for the back half of this year. I'm going to kind of build my case for that here in a little bit. But these folks are not just planning for the rest of 2023. They're planning for, I'm going to work another 30, 35 years and hopefully have enough to retire on. You better start investing that money today. And my guess is the reason why they're sitting on all this cash is for the first time in 15 years, all these millennials, they're now finally starting to be able to put money to work. Last year was the first time in 15 years where the market lost money. And it's kind of a wake-up call, like, oh, crap, I can actually lose money in the market at any one point in time. And I think that's why their emotions are driving that decision to continue to build on this cash reserve and allow it to sit on the sidelines and not actually have that money working for them.
Yeah.
If that's you, give me a call, man. This is what we're here to solve for, 513-630-2664. So I just wanted to get that out there.
I mean, as an elder millennial who I can tell you that it took me a long time to, not a long time, but I definitely had to just get over a general existential downer when it comes to the future of the American economy.
Yeah.
It wasn't until I spent a lot of time with you and saw the actual historical track record through all these different, global tragedies and even just, national tragedies that the economy rallied through that I actually began to have faith in it. Because, for me, right when I got out of grad school, basically, and hit the workforce was the global financial crisis.
Yeah.
And there was no hope of saving money for me, and people I knew at all for years after that. You were still playing catch up, and recession hit and lingered. And really, I only had about 7 years to save money and invest then before the pandemic came and ruined everything again. So I think what you're seeing is I think that study's totally right. What maybe they're not addressing is that there's just a general existential dread and doom, a sense of doom to the millennial that it doesn't matter if I get in 7 years or to have some good years, that some horrible climate crisis is going to come and ruin everything. And, that there just isn't a faith in the future, period.
Right.
I think that's indicative of.
Yeah, I mean, I'm just here to let everybody know, I understand the emotional side of investing. And Buffett said it famously himself, the number one hurdle that individual investors have is themselves.
100%.
And what he's referring to is their temperament, right? They don't know how to control their emotions when things are either really good or really bad. And that has everything to do with this concept of behavioral finance. You can get a PhD in this topic at pretty much every major university. And essentially all that study tells us is how human beings make decisions with their money under stressful circumstances. And what that study has found is that humans feel losses twice as much as they feel good about making money.
Yes.
And that's really what the crux of this program is all about, is to help you understand that is an actual thing that's built into you as a human. You have this, fight or flight, this fear and greed, tug of war going on inside of every person. And people are what make up the market. And that's why the market over a long period of time is extremely predictable, because human beings, what we know for sure is they don't learn from history, what Buffett also said famously. And we really haven't changed all that much in over 2,000 years. So it's time to get on board with the concept here that the market will have its ups and downs. Your job as an individual investor, you can control two things, right? We could sit here from now on, from the end of time, and talk about all the stuff that investors can never control. You can control two things, though. One is your asset allocation, which is just a fancy way of saying this is how much of your money should be invested in stocks, bonds, and cash.
Yeah.
You always have control over that. And the great news about that is that explains 94% of the variability of the performance in your account over any period of time that you want to take a look at. You have control over that. And the other thing that you have control over is your temperament. Like, how are you going to filter through all the headline news? And that's really what this program is about. The news does a good job of telling you this is what happened today. This is why it happened. The reason I do this show is I'm here to tell you that, yeah, whatever's going on today that caused that headline news to be awesome or terrible, and this is the end of time, there's always a historical precedent. I'll give you one caveat. That was the global pandemic. There's not really a precedent for that.
Right.
So I understand that one. But any other time you want to look at, there's usually a precedent in the past that we can refer back to and say, oh, this happened 8 other times in the last 50 years. And this is what the outcome was 6, 9, 12 months later. That's what the news does a really bad job of doing. They're giving you the headline news because that's what drives the eyeballs, the attention. And that's the reason why there's so much cash still sitting on the sidelines. So I'm not here just picking on millennials. If you look at the do-it-yourselfer investors, if you look at the institutional investors, I mean, there's still like $5.5 trillion sitting in cash, money markets, that otherwise would be invested in the market. And it just hasn't participated at all yet.
Right.
So to me, that's another tailwind that's going to drive this market higher, because eventually that fear of missing out, especially if you're a professional like myself, we're fully invested. We've been invested in heavy tech, heavy industrials, having energy exposure all year long.
Yeah. Same here. As much as I'm able to, I'm fully invested.
You can go back and listen to all the former podcasts. Just go to shepherdwm.com and you'll hear why we did what we did. But the headline news was recession was 2023. Like, that was the consensus. It's going to happen.
Yeah. And if you haven't put your toe, if you haven't participated in the market, then why would you jump into the recession? I mean, it's a natural fear.
Exactly. And if it was going to be a recession year, you damn sure don't want technology and industrials. Like, that's the obvious thing that you don't want to have exposure to.
Right.
We didn't take the contrarian view just to be contrarian. We backed it up with historical data. And that's what I think the news drops the ball on, but it's really not their job, I guess. If they were like, I want to make sure that when I present this news that I kind of give some holistic, information around it, not just saying, oh my God, we have this problem, inflation. And inflation's a problem. And that's going to just destroy everything, right? Well, there's also historical precedents for inflation. So they just do a bad job of giving you the whole picture. And that's what this is about, because if we know what happened in the past, and of course, past performance is no guarantee of future results, and investing does involve risk, including risk of loss. There's your statement for all the compliance people out there. However, the past has a really funny way of repeating itself, specifically when it comes to the market, because it's made up of human beings. So here we go.
Yeah, or at least giving you a framework to begin a strategy when you might feel like you don't have one. Right?
Exactly.
You can at least start somewhere.
So let's start with the first part of this.
Let's do it. We
got a couple things going on here, I think. So we'll start with the data.
Well, good. We already gave them the appetizer. Let's give them the main course.
Inflation falling faster than people think. So first, good news. GDP for Q2 was positive 2.4%. Consensus thought it would be 2%. So the economy is growing, right? We're being very productive. That's awesome. That's not a recession.
Right.
So I don't know who's still calling for a recession. You can still find articles on the internet right now, but people keep pushing back this recession concept out 12 months. So now it's sometime in 2024. We'll see. Maybe it happens. Yeah, eventually somebody's going to be right. They keep pushing this thing back far enough. Eventually somebody's going to be, yeah, I called that. No, you didn't. So GDP is up better than consensus expects. And the Fed's favorite inflation measure, which is core PCE, that came out this morning at 8:30. Core PCE year over year came in at 4.1. Economists were expecting 4.2, so lower is good. Previously, it was at 4.6, so it's quite a bit of a drop there from a percentage standpoint year over year. So core PCE month over month came in at 0.2%. Economists expected to come in exactly at 0.2%. So it came in line. Previously, it came in at 0.3%. So again, month over month, we're lower. We're trending in the right direction.
Yeah.
By the way, the peak of core PCE was February of 22, and that was at 5.4%. So from a percentage standpoint, it's quite a bit of a drop here. So it's not completely where the Fed wants it to be, right around that 3% number, because when PCE is about 3, that generally means the headline, the CPI print that I just talked about came in at 3%, would be trailing at about 2% annual run rate, which is exactly where the Fed wants it. So we're within shouting distance. Now, the great news is the Fed doesn't meet again for a couple months. So we're going to get 2 more CPI prints and 2 more job prints before the Fed actually, hops on the mic again and either raises rates or holds them steady. I don't expect them to cut rates at all. So I kind of was hoping for that earlier in the year.
Yeah.
But now that the economy is so strong, I don't really see a reason to cut rates. I think the cutting of rates will likely happen sometime beginning first half of 2024. Just simply because if inflation continues to fall at this sort of pace, then there's really no reason to have interest rates that high. And you can start to expect interest rates to fall, which is great for all real estate investors, people that maybe need to refinance or looking at purchasing a home for the first time or just buying a home in general. I know interest rates are very high right now, 7-ish% or so on a 30-year fix, but I'm kind of expecting those things to start to fall in 2024 and beyond. So if you are in that space, then go shopping because you're going to have to refinance in 18 months, but it's no big deal. So really good job, really good data from a U.S. economy standpoint, and inflation's falling faster than consensus. I just talked about CPI being at 3%, which is really, really close to that 2% target the Fed's looking for on CPI. We also talked about the other second reason why we should still expect a bull case is earnings.
Yes,
earnings have been awesome. I'm gonna share some recent reports from some pretty major tech companies here in just a second, but just broadly. So everybody said this quarter earnings was just going to fall off a cliff. Well, 243 companies have reported so far on the S&P 500. That's about 50%, actually 49%. Earnings per share, 79% of the companies that have reported thus far have beaten their earnings per share estimates. That's awesome.
Wow, that is awesome.
They've been beating by a median of 6% too on the bottom line, which is, again, these are really, really good numbers. Historical precedents, this is better than that in general.
Yeah.
Revenue, so the top line number of the companies that have reported thus far, they're beating their revenue estimates by about a median of 3%. So still really, really strong stuff. With inflation falling, generally companies or some companies would have a difficult time keeping that, increase in their price for either their service or their product because inflation went up. So some of them are able to keep the prices a little higher, but prices have come down at least a little bit in certain respects in certain sectors of the market. So the fact that they're still beating on the top line by a median of 3% to me is pretty impressive. Now, we also had some really good earnings reports from some major tech players. So Meta, formerly known as Facebook, crushed the numbers here. So for June, Q2 earnings, they beat earnings per share estimates by 3.2%. They beat the revenue estimates by 3%. I mean, it just knocked the cover off the ball. Revenue's up 11%. Net income's up 16.5%. I mean, they're just knocking it out of the ballpark here from a Meta standpoint. And they just came out with Threads, which I haven't messed around with yet. Have you played with that?
I haven't either, no. I have to curtail my social media exposure or I get too obsessed.
I understand. But I think that's really great for them. The call was awesome. The year of efficiency from Mark Zuckerberg is showing up in the performance on their earnings call. Obviously, the stock price has done phenomenal this year.
Yeah, it surprised me, especially with the kind of the failure of the metaverse so far.
And he's still spending on it. So I got this number yesterday, $32 billion with zero return on the metaverse. Like, what other publicly traded company can you think of that lost $32 billion and their stock is just face ripping rally, up and to the right?
I mean, that even hearing that data, it's hard to believe that you didn't just spin me some BS. Like that's insane. Right. I can't think of anything like that.
And he's going to continue to spend on it. But so the earnings call was cool in the sense that, the first half of the year for Facebook was all about efficiency. So laying off people that weren't, probably didn't need to be there.
Yeah.
I feel bad for all those people, but based on the jobs report, it seems like all those people found a job somewhere else.
That is the only silver lining, hopefully for them.
Yeah.
Is that,
So I'm not here to say I don't want people to work. I do.
We talk about it all the time about squashing employment is not awesome, not American.
100%. And for Facebook, the earnings call shifted to, it was a year of the efficiency, but the back half of this year and going into next year is all about growth. And here's the way that we're driving growth. And it was just such a cool shift that he made. And he's I don't know if somebody else's, helping him understand what Wall Street is expecting of him and his company. He's like a Wall Street whisperer now. It's like perfect timing because the market was not about, hey, you can only let go of so many people here. Where's the growth going to come from now?
Yeah. The thing, I mean, ever since the innovation of Facebook, you know, when it came in, really you had MySpace and kind of, you know, then some chat rooms, you know, things like that. But Facebook really was innovative. It was a new thing. It seems like the strategy for Meta has just been find what's working and kind of swallow it and buy it and be, you know, like Instagram, Facebook didn't come up with that. It was its own thing and they sold themselves. They sold their company to Facebook.
Well, like, really what it comes down to is the ads.
The ads, yes. But like, as far as like being innovative, I think Facebook doesn't develop their own stuff. They just find a way to see what's got a potential and pull it into their own sphere.
Right.
And I think with the tanking that Twitter is having, they did that again. They were just like, well, let's take what was good about Twitter and just make our own version of it.
Right. Taking a playbook out of what Apple generally does.
And then he's literally going to fight that guy. He's going to box Elon Musk.
Why not?
So that to me is where, I mean, don't ever, I guess, count that guy out, you know, just because of the ability to just take a strategic look at the current field and say, well, where's probably things going to go in the future, and then they just absorb it instead of having to develop it on their own. They basically crowdfund their own innovation.
Yeah, they have the data, right? You know, because 3.5 billion people on the platform, you know, every single month, literally half the planet.
And no matter what you want to say about Zuckerberg, he clearly knows what he's doing in this regard. He is still kind of a visionary.
Oh yeah, he's like a John D. Rockefeller kind of guy to me. And essentially, you know, what that call showed, and we're going to talk about Google here next. If you're an advertiser, like you're trying to promote your product or service, you're going to Google and you're going to Meta.
Yeah,
for the
really are.
I mean, that's where you're going. And the reason why is not just because they have the audience, but because of the data and now AI, they're able to get more specific targeted ads in front of the right people at the right time. And that's what makes it a super powerful platform. And of course they can make money in other ways too. So it's just really cool. And everybody was talking about how, you know, last year Meta lost 70% of its value on the stock price in 1 year. We held on to it. We kept investing in it and all that sort of stuff.
I mean, I was kind of kicking them while they were down just because I didn't see how they were going to come up with something to stay relevant.
Right.
You know?
And they did. I love it. And now we're getting into Google. So Alphabet, I don't know why they changed the name to Alphabet. I'd have to ask the CEO that one.
Dude, why is Twitter going to X? Nobody's going to.
That's kind of, well, I guess that might be a different podcast in and of itself as that rolls out, just because it's trying to be an everything app. And that's actually been wildly successful over in places like Asia. So we'll see how that works out here in the States. But that's definitely a topic that we'll probably get into at some point. But Google knocked it out of the park as well. Revenue beat by 7%, net income up almost 15%. Profit margins are up 7%. I mean, again, just knocked it out of the park. Led by ads as well as YouTube. YouTube numbers were better than analysts expected, but also the ad revenue was way stronger than what analysts had ever thought would happen, just due to the fact that everybody was calling for a recession. Therefore, they're not going to spend on ads.
Yeah, and with streaming services now kind of backpedaling and trying to figure out how to stay liquid, or not liquid, but how to make money.
Yeah.
You know, I mean, you're seeing like Netflix people are going to go back to pirating, but as long as there's a free YouTube app with live TV, that is going to get much more traffic. So
we love the YouTube Live. We're on it right now.
Yeah, we do utilize it here. I mean, it certainly is a great tool.
Absolutely. So keeping on the earnings theme here as the second reason why you should expect a bull case. Microsoft, even though the stock dropped after earnings, it was an awesome quarter, and I'll talk about why the market had a short sell-off here for Microsoft, but the stock is recovering, it looks like, today. So Microsoft, obviously revenue was up quite a bit, 8%. Net income's up almost 20%. I mean, again, just absolutely knocked it out of the park. Revenue's up over 2%. The reason why the stock sold off was it popped initially when these numbers hit the wire on their earnings call, but then the earnings call happened with the CEO and the CFO, and they were asked by analysts as to the extent of their spend, their CapEx spend on AI being higher than what they originally thought it would be. Obviously, it worked. It's showing up in the numbers, but I think people kind of had a knee-jerk reaction to this idea of like kind of like the Zuckerberg things. I'm not going to say he's wasting money in the metaverse. It just hasn't actually generated any profits yet. And that was why, a lot of people with interest rates going up last year, why Meta stock fell so hard. So the same sort of concept was tied into this Microsoft earnings call after they showed these awesome numbers. Analysts were like, oh crap, you're going to spend, more money than what we think you need to spend or was expecting to spend on artificial intelligence. Therefore, you saw a knee-jerk down, but actually bought more the next day or two after that actually happened. So I'm very excited to be a Microsoft shareholder, and the numbers were nothing but stellar. Next week, we get some Apple and Amazon earnings, kind of rounding out all the big tech. So I'm very, very excited. And then the last one is NVIDIA, which isn't until like the end of August, somewhere around.
Well, that one should be pretty good because they had a big turnaround, didn't they?
Oh yeah, I mean,
like earlier this year, that stuff popped off.
Yeah, because their guidance from their last earnings call, they said, "Hey, we're going to generate $4 billion more than what you guys are counting on us making." So the stock just obviously shot up into the right, and became less expensive on a price to earnings ratio just because the expectation of future growth is phenomenal there. And that's where everybody's spending this CapEx thing that I just talked about.
Yeah.
Well, I'm getting ready to talk about. So it's the third reason.
Yeah.
Why I think the bull market case is still valid is NVIDIA is the place. Like they're really, yes, there's Taiwan Semi, there's AMD, but nobody makes the type of chip that NVIDIA does to do what these companies want to do with artificial intelligence. So they got to go to NVIDIA, which is why they guided $4 billion higher than what analysts has expected.
Wow.
I'm not selling a share of that thing unless obviously a client situation comes up that's very specific. They have to go to NVIDIA to get this. And this is where, Meta, Google, Microsoft, all these major players are spending money, and it's going to NVIDIA. And what is NVIDIA doing? What problem are they solving? We talked about this since October last year. There's been historical precedents of labor shortage in this country. Not the first time this has happened.
No.
And every single time, CEOs and CFOs, they have to do these quarterly costs, right? And they don't want the stock price to go down, obviously. So they have to solve the problem. And the only way to solve a problem when you can't clone human beings legally, and you're not going to wait around for Congress to pass some sort of immigration law to get more people into the country to work in your factories or whatever, you have to automate that somehow. And there's a precedent for that going back to like the 30s and decades, leading up to now.
Mm-hmm.
And every single time it kind of causes what I would call a super cycle of innovation from a technology standpoint, and tech became what it is today. You go back to the 30s, there really wasn't a tech sector in the S&P 500. Today, it's the largest sector by a long shot. 30% of the whole S&P is tech. And that had to come from innovation. That's exactly what you're seeing now. You're probably likely to see that continue for the next 10, 15 years. And I'm expecting a lot more to come from these types of major companies here. So I'm extremely bullish, as you can tell. I've been on the right side of this trade all year long, so that helps. But I expect more to come here from these large cap tech companies, and specifically the NVIDIAs of the world. So that was kind of the highlights of why I think we're going to continue to see the bull market continue. And wanted to touch on a couple other things here as well that I thought was interesting. So Tom Lee, he's the head of research for Fundstrat. I'm a big fan of theirs. I get research from a lot of different places. I love his stuff probably the best, simply because they actually look at historical precedents to back up their rationale, right? So they're saying whatever they're saying, we're bullish on whatever. And they lay out a case, and they usually back that case up with some sort of historical precedent. Like this has happened 12 other times over the last 75 years. And he's been kind of spot on this entire time. So there's a couple of things that stood out that Tom Lee highlighted that I just wanted to share with the audience here as to why I think that we have now seen the last interest rate hike of this cycle. So I don't believe that we're going to see any more interest rate hikes for the remainder of this year. And I think that cuts can actually, become a real thing in investors' minds sometime in 2024, which is obviously a good thing for markets as well.
Yeah.
So here's what Tom Lee kind of highlighted from the press conference just the other day from Fed Chair Jerome Powell. So Powell stated explicitly that they're going to stop raising rates before they get to 2% inflation. So consensus was saying they're going to keep raising rates until they see 2% CPI.
Yeah, they've been barking that for a while.
100%. But Powell actually said in his statement in front of all these reporters and the whole world that they're going to stop raising rates before they get to 2%. And that makes total sense to me because if inflation is in fact falling, why keep jacking around with rates when it's already going to get to where it's going to get anyway?
Yeah, with the lag effects that we talk about all the time.
Exactly. So that's key. In some FOMC meetings, these other Fed heads, those members have talked about wanting to stay tight, meaning continuing to increase rates until they see 2%. But in our view, Tom Lee's view, the reality is that the Fed is going to slow once inflation is on a glide path lower. So again, we get 2 more inflation prints before the Fed meets again, 2 more job prints before the Fed meets again. The Fed didn't know the PCE was going to come in the way that it did today. Their meeting was on Wednesday. Here we are on Friday, and we get another inflation measure that's actually the Fed's favorite gauge on inflation, falling faster than consensus expects. So this is great. We're seeing that glide path lower. Next thing that Tom Lee pointed out from the Fed meeting, Fed staffers. So these other Fed heads, there's like literally 1,000 economists, which I don't want to hang out with 1,000 economists, but they kind of forced to. The Fed staffers are no longer forecasting a recession. Even the Fed and all these economists that work for the Fed were calling for a recession all year long in 2023. I told you guys the recession was last year. And the reason why it was last year is because that checked every box for a recession except for unemployment.
Right. Yeah, go back and look at the archive on the YouTube page of the podcast from last year. That's exactly what Joshua was calling for. We were saying that out loud a lot.
Yeah. So that's great. And the other thing that Tom Lee highlighted here is finally, the most important thing that Powell said in our view is, quote, the June CPI was better than expected for a change. So that 3% number being lower than what economists had been calling for, Powell, quote, said that June CPI was better than expected for a change. That's awesome to hear him actually acknowledge the fact that inflation is in fact falling.
Yeah.
And it's getting very close to their destination of the 2% CPI print. And the rapid increase of interest rate hikes that they did in 2022 is actually now starting to show up in the data. Again, the lag effects that we've talked about, as well as other Fed heads have talked about as well. So this is all pointing to me. I kind of highlighted this, I think, in our last podcast. I definitely highlighted it to the newsletter that I send to all my clients at the beginning of every month, that I now kind of expect the market to hit a new all-time high sometime in 2023, likely in Q4 generally is what I would expect that to take place. And I'm calling for around 4,900 on the S&P. I think the last high was like 48.20, 48.21, something like that.
Yeah.
So if I'm right, then we maybe have another 10% or so in the S&P 500 before we end the year. And the bitch of it is, if you were to just watch, consensus headlines, there's 20 of the largest institutions that put out their forecast for what the S&P 500 is going to end up 2023. The median expectation was 4,000. We're almost at 4,600 today.
Yeah. Even earlier this morning, the people on the talking heads up on the monitors in the offices, they were still doom and glooming it. Like, oh, let's not get excited about where things are or think about positively in the future. We're still going to see a recession. It's like, what?
They're on the wrong side of the trade, and they need to get out of their own emotional temperament problem. Is it just simply been on the wrong side of the trade, and they have to answer to their shareholders as well. I'm glad. Like, people are taking my calls gladly. Like, yeah, let's do a quarterly review. Can't wait to do this.
Yeah.
So it's been a lot of fun to be on the right side of the trade. And obviously that's not going to happen every single time perfectly. We were on the wrong side of the trade last year, at least for a little while. I was probably a little bit too bullish for the first 2/3 of the year. But we definitely pivoted quick, going into heavy sectors that were performing well, like energy and healthcare. So that's the reason why we do this show, is to give you guys not only our take, but back it up with some historical precedents, some real life, stuff that's happening today, and giving you guys what others are saying that you might not actually see on CNBC all the time. Because I bet if I were to sit here long enough, days, months in a row of watching, things like CNBC and Fox News, I bet the vast majority, I'm thinking 85% of the time, the guests that they have on there generally have a negative view.
Oh yeah. Even when things are going good.
Right.
Yeah.
And you're still seeing that today, to your point.
And I think that also adds into that just generalized, the investor sentiment, especially for the millennial generation, have just been beat in by the market, from the two crises that we've seen in the past 15 years.
Yeah.
And then they turn it on. It's like, well, then why would you participate?
Yeah. Well, the other great news that we're seeing in the market as well is that, everybody keeps talking about the Magnificent Seven, the Teslas, NVIDIAs, Microsoft, Amazon, Google, Meta, et cetera, Apple. They did a lot of the heavy lifting, the first half of this year, but now you're actually seeing other sectors participate. Financials are stabilizing. Regional banks are doing great. Obviously, the big banks, they just reported this earnings cycle. They knocked it out of the park. JP Morgan, Bank of America specifically. You're also seeing energy finally start to participate in this market rally, which was something that we thought would have happened earlier in this year, but now it's like peak travel.
Yeah.
Right? So people driving around, airports are packed. You're getting ready to go on a flight to Hawaii. I bet that's packed.
It most likely will be.
Yeah.
I might even mask up, not because I'm afraid of COVID. I just don't want everybody else's breath on me.
I'm with you on that, man. But yeah, so it's peak travel season. Obviously, the OPEC Plus group decided to cut production yet again. That was a little bit of a surprise. So I kind of was anticipating that energy would have a rally at some point and participate in this market rally, but we're seeing that now.
Yeah.
All the stuff that everybody said that you should be in heavily, like healthcare, staples, utilities, that worked last year. This is the worst performing sector so far this year. And that obviously will recover at some point. It'll bottom out, and that'll be a place that you want to be in at some point. And maybe that's something that we'll talk about later on in the year from a rebalance standpoint. You're getting a lot of gains from industrials, a lot of gains from tech, which was our two favorite sectors coming into this year. And I think you're going to see some nice gains here from energy. The question is what's going to happen in an election year of 2024. And to be honest with you, man, I can't wait to talk about anything else besides interest rates and the Fed.
Even if we're back to that election cycle, because
next year's
going to be nuts.
And that sucks a lot because I've been doing this long enough to been through multiple president cycles where I've been a CFP and I'm guiding people through all this stuff. And that drives more emotions than anything.
Oh, no, more knee-jerk, reflexive, just like,
yeah. So I already know the playbook for next year.
Yeah.
I know what we're going to be talking about, but I'm so excited for finally, what has it been? Almost 2 years we've been doing a lot of these podcasts. And kind of the main thing that we talk about is what's the Fed going to do and how's it affecting the markets and investors?
Yeah.
I can't wait to do something else.
Yeah. I mean, it has seemed like the last 12 months have been pretty redundant as far as the things that we've had to cover here. You know, temper everybody's fears. No, the sky's not falling. It's nowhere near like 2008. Right. Don't listen to the recession talk. We already went through it.
Right.
Bull market. And you're right. It would be nice to talk about something else. I just don't want to have to talk about that.
Trust me. It's something we're going to have to talk about.
Yeah.
The great news is talk about historical precedent of data.
Oh,
just get ready for next year, guys. It's going to be a really good podcast.
Yeah.
I'm going to lay it out for you. So this has been a lot of fun. I know that we're kind of up on time here. Anything else that we want to make sure that we get to before we wrap up?
Let's just recap. We went through the three reasons why you're still bullish.
Three reasons for the bull case. Inflation falling faster than consensus expects, falling faster than what the Fed even expects. Earnings have been nothing but stellar, number 2. And last but not least, this CapEx spend that major companies are doing as far as solving this problem of I don't have enough workers, yet I still need to get things done. So they're spending it on AI, even though AI was only rolled out and introduced to us in November of last year. That is actually showing up in a profitable way for companies on these earnings calls. And I expect that to accelerate. So those are the 3 reasons that we're still very, very bullish. And if you missed the market rally, there's still some time to get some recovery. I expect more to come here. So stick around to the next podcast that we'll do about 2 weeks from today. So that put us in freaking August.
Man.
So just a few months left in the year here. And almost done with summer and back to school. So I'm actually excited about that. I know my wife is more importantly. So 3 reasons to be bullish. If you missed a rally, still expect a little bit more. I hope you guys have a great rest of your day today. We'll do this again in a couple weeks. You can check out all the archive podcasts, all my newsletters from this year, The Friday blogs that I do, I'm gonna have to write that today, actually. You can go to shepherdwm.com. You can check out all that stuff. You can certainly send in questions that you might want us to answer or address right here on the show. You can send that to me directly via email, which all that stuff's on the website. My phone number is there as well. You can text the questions 513-630-2664. This has been a lot of fun. Look forward to doing this again in a couple weeks. And I hope you guys have a great rest of your day. Take care.